Let's talk about bail-ins. Are the rumors true? Can banks really take your money? How is it legal? And who made this possible? Hey everybody, you're watching Bo Boom Bear Bust. Thank you for joining me. Now up front here, if you haven't done it already, please give us a subscribe. We're running low on views again for some strange reason. So please subscribe if you haven't done it already. But the answer to my question there at the beginning, the answer is yes. Bail-ins are real and they can happen here in the US. And many well-known economists are saying yes, it definitely will happen. Not just can, it will happen. Okay, so we're going to get into the actual documents and the act that enabled bail-ins to happen here in the United States. Alright, now first of all, for the skeptics out there that think that it's too bad or too crazy or too crooked or corrupt to be real, well, it's already happened in Europe. Here's information out of Forbes here. Alright, these pop-ups keep coming here. And they did a nice write-up on the Cyprus Bank bail-ins, and they describe it as a new strategy that's been unveiled around the world. And they're saying here that the first test run was Cyprus, but that this strategy for insolvent banks has already been made legal here in the US and other countries. So let's go straight to the document. Let's see what the document looks like that says there's bail-ins. Let's see right here. Here it is. Banks can take your money. That's the official document. Haha. Just kidding. We've got the official PDF, and it was legalized under the Dodd-Frank Act. Now, of course, they're not going to come out and say banks can take your money. It's not going to be put in such simple wording. It's going to, okay, they're not going to make it easy for you to figure this out. Of course, that's what they want, right? It's buried in a 376-page in PDF format. That's how many pages it is, the Dodd-Frank Act. So we're going to go through the parts of it here. This is in Section 2 of the Dodd-Frank Act. Okay, but let's first talk about why bail-ins. And bail-ins have been described as the biggest threat to average U.S. and G20 country savers. And that was said by HSBC's James Steele. So the FDIC, they're no longer just an insurance agency to come in and save bank depositors when a bank fails. But the FDIC is now the primary executor for the bail-in process. So if you ask most Americans, they'll tell you that they believe that their bank accounts are protected and that the FDIC backstops their money in accounts up to $250,000. However, if you push a little bit further and ask them if the FDIC has any other function, they'll usually not know at all. They'll probably give you a blank stare. Or they might say something like, oh, it's a government agency, they only have one purpose. Well, ever since, well, just a few short years after the financial crisis, the FDIC has taken on a much larger role. So back in 2012, the FDIC met with the Bank of England in a joint conference to hash out framework for bail-in procedures, not only if banks go insolvent, but also for if there's a sovereign debt default in the wake of a financial collapse. So the most important part of that for you and me is that the FDIC now has the power to write down your account without ever having to compensate you through promised insurance as they were required by law prior to the passage of the Dodd-Frank Act. So it is in Title II of the Dodd-Frank Act, and it provides the FDIC with new powers to resolve SIFIs. Those are systematically important financial institutions. And if you've been on this channel, you know that we've talked about that these banks have been declared too big to fail because debt is now the economy, right? So without debt, we would have no economy because most people to even spend have to go into debt. People are putting groceries on their credit cards. Not everybody, but debt has become something that most people are under right now in this country. Okay, but back to the FDIC, it establishes an orderly liquidation authority, that's an OLA, and the FDIC may be appointed receiver for any U.S. financial company that meets specific criteria, including being in default or being in danger of being in default, and whose resolution under the U.S. Bankruptcy Code or other relevant insolvency process would likely create systemic instability. Title II of the Act here in the U.S. requires that losses of any financial company placed into receivership will not be borne by taxpayers. That means it's not going to get added to the national debt. but by common and preferred stockholders, debt holders, and other unsecured creditors. So if a large, too big to fail bank fails in the U.S., the FDIC steps in and takes over, replacing management of the bank, and works to shrink the bank by writing down liabilities and converting debt into equity. In other words, any liability at the bank is in danger of being written down should a bank fail. And guess what? Deposits are considered liabilities according to U.S. banking law, and depositors are creditors. Okay, so basically as a depositor, you're putting your money into the bank. You are providing the bank an unsecured loan. Okay, repeat that. Depositors are creditors. So it's the same thing as someone charging up a credit card and writing off the debt, and the bank takes the loss. In this case, the consumer takes the loss. The saver with the savings or checking account takes the loss, as the savers and depositors are the unsecured creditors to the bank. Now, Jim Sinclair, the chairman and CEO of Tarzana Royalty Exploration Corporation, and whose family started Goldman Sachs, Salomon Brothers, Lehman Brothers, and others, has been warning of this for a while. And he says, quote, "Bail-ins are coming to North America without any doubt, and will be remembered as the great leveling of the great flushing. Not only can it happen here, but it will happen here. It stands on legal grounds by legal precedent both in the US, Canada, and in the UK." Unquote. Now, financial expert Michael Snyder says the following, quote, "When major banks fail, they're going to bail out them by grabbing the money that is in your bank accounts. This is going to absolutely shatter faith in the banking system, and it's actually going to make it far more likely that we'll see major bank failures all over the Western world." Unquote. Now, while this isn't new news, the story is still developing. The monetary system is much closer to collapse, and the bail-in is imminent. In fact, U.S. banks presented the Federal Reserve with a bail-in plan to pay for large banks' restructuring in the event of a future crisis. The Wall Street Journal reports the plan was presented to the U.S. Federal Reserve in an attempt to preempt tougher rules from regulators. This private meeting was reportedly attended by officials from Wells Fargo, Bank of America, Citigroup, and other large banks. The bail-in mechanism would be designed to place a greater burden on creditors as opposed to taxpayers, who were the theft victims from the previous bailout. In addition to the fleecing of depositors in Cyprus, the burden keeping a bank afloat was put on bondholders already this year when the UK's Cooperative Bank unveiled a rescue package that forced the bank's bondholders to take a $1.5 billion hit to plug the $1.5 billion hole in the bank's balance sheet. In the end, it's not just creditors who will be on the hook, but depositors as well. Now, Jim Sinclair pointed out that the banks legally own depositors' funds as soon as the depositors hand those funds over to the banks. The money becomes the bank's, and the depositors are actually unsecured creditors holding promises to pay. Previously, the banks were obligated to pay back this loan on demand with cash. Under the new FDIC plan revealed this year, however, these promises to pay become equity in the bank, which won't become able to be used as payments for bills, which is why most people have money in the bank in the first place. Okay, now back into the text here of the actual Dodd-Frank Act PDF document here. And we're going to skip down to page 98. And we see the wording again here, unsecured creditors. So the corporation shall ensure that shareholders and unsecured creditors bear losses consistent with the priority of claims provisions under this section. So we're going to link to this whole PDF plus the other articles that I was mentioning that have the quotes from Mr. Sinclair, and also the article with the quote from HSBC's James Steele. Okay, now the following is going to be just my opinion. And I'm not giving financial advice, just my opinion here. So we've already been told right out of the Federal Reserve that interest rates are not likely going to be raised in 2019. We've got Larry Kudlow, Trump's economic advisor, out there saying that there's not going to be any rate hikes in his lifetime. So we know that they are looking to create inflation. We know they're looking to devalue the currency, devalue the dollar. Okay, combine that with the facts that banks are hardly giving anything on deposits right now. We showed a couple episodes, it was like a 0.5% CD rate to deposit a CD at a bank with some of the larger banks. So your money is worth nothing to them, and basically you being an unsecured creditor to the bank, you may find value in putting your money in other locations. I'm not saying you should do this, but you should consider all the risks, including putting the money with the banks. So do you think, ask yourself, do you think the banks have gotten more responsible since 2008, that they're concerned that they're doing the right thing with money, they're not gambling it? Do you really think they're not over leveraged this time, meaning they're loaning out many, many times what they actually have in deposits? So I'll give you a couple guesses as to where people may try to put their money when trust in the banking system is lost, when there's panic, when there's bank runs, when we see banking holidays, meaning you can't get your money out of the ATM, the banks are closed, which has also happened in other parts of the world. Will people be running to put their money into cryptos? Will it be precious metals, gold and silver? Okay, I'll leave it at that. What do you think? Let me know what you think down in the comments. And I want to thank everybody for watching. If you like what we talk about here, please give me a thumbs up. It definitely helps the channel. I'm going to link to all the articles. Just look down in the description. You're going to see the PDF for the Dodd-Frank Act. All the articles pointing out which section the wording is in there, showing that your deposits are unsecured credits, or you're unsecured creditor to the bank. All right, people. Hope you're staying above water. Thanks for watching. We hope to see you next time on the channel. Bye.